The patterns are clear. Every financial crash in the last century has followed the same sequence. And as the days unfold, we're seeing it happen again. 1929, 1987, 2000, 2008, they all followed the same five-stage pattern. These weren't accidents. These crashes were inevitable, built up over months, even years, by the same missteps. And guess what? We're in the middle of it right now. The Federal Reserve, Wall Street, and the financial elites know this. But what's alarming is that the average person, you, me, and millions of others, have no idea it's coming. This isn't just about the markets. It's about your future, your savings, and your retirement. And the scariest part? It's further along than you think. Let me take you back to 1929. A man named Roger Babson stood up at a conference and gave a warning. He predicted the inevitable crash, and it turned him into one of the most hated men on Wall Street. He said, "Sooner or later, a crash is coming, and it may be terrific." People laughed, economists ridiculed him, and 47 days later, the market collapsed. But here's the thing. Babson wasn't just throwing out a prediction. He had a systematic approach to analyzing financial conditions. He looked at credit levels, debt, liquidity, market behavior, and the vulnerabilities that would inevitably trigger the collapse. He understood what nobody else did. This is where we stand today. Let me walk you through the 5 stages that Babson studied and show you where we are now.
The first stage is often the quietest, hidden beneath the surface. But it's the most dangerous. This is where the foundation of every major financial crisis is laid, the credit explosion. It doesn't begin with a bang or with wild speculation. It begins with something more insidious: debt. When credit begins to expand faster than the economy can absorb it, the seeds of collapse are planted. Take 1929, for instance. People were borrowing money they didn't have to buy stocks. The stock market was filled with ordinary people leveraging everything they owned just to keep up with the rising tide. By the time the market hit its peak, margin debt had surpassed even the size of the federal budget. This was no longer about investing. It was about borrowing to buy more borrowed money, a massive house of cards built on borrowed funds. Fast forward to 2008, and you see the same story. It wasn't just the banks that were levered up, it was ordinary families. People were taking out loans they couldn't afford, buying homes with no money down, and using adjustable rate mortgages that were doomed to fail. Mortgage lenders offered terms that should have been unthinkable, and yet they were handed out like candy. But the house of cards doesn't stay standing forever. Eventually, it begins to crumble. Today, we're in the middle of a similar situation. The credit explosion we saw in the late 1920s, the early 2000s, and again in 2008 is playing out once more, and the numbers are staggering. The total debt in the American economy is higher than it has ever been. Consumer debt, corporate debt, government debt. It's all rising at a pace we can't keep up with. The margin debt, corporate borrowing, and government deficit are all warning signs. And yet, we continue to borrow more. This time, the consequences will be even more devastating. The foundation has already cracked, and the next stages, they're closer than we think.
The second stage of a financial collapse is where things begin to look dangerously unstable. This is the concentration trap. It's not just about high prices, it's about risk becoming concentrated in the hands of a few key players. And when a small group of assets or institutions hold such a large percentage of the market, the system becomes fragile. In 1929, the market was dominated by a handful of companies that were overinflated. One of the biggest was the Radio Corporation of America, RCA. It went from being worth almost nothing to over $500 per share. People were obsessed with this single stock, even though they didn't fully understand the technology behind it. RCA was everywhere, and because it made up such a large percentage of the market, its failure would trigger a cascade. When it cracked, the entire market cracked with it. We saw the same thing happen in 2000 with the dot-com bubble. The market was driven by a small group of tech companies like Cisco, Intel, and Microsoft. These names were the face of the entire NASDAQ, and when they fell, it caused trillions of dollars in losses. Similarly, in 2008, the banking sector had become so concentrated that the collapse of just a few institutions, like Lehman Brothers, nearly took the entire global financial system with it. Today, we're repeating this same pattern. The top 7 companies in the S&P 500 now account for over 30% of the index. Apple, Microsoft, Amazon, and a handful of other tech giants are propped up as the foundation of the market. But the issue is the same as it was in 1929, 2000, and 2008. If one or more of these companies stumbles, the entire market will collapse with it. It's happening again, and it's even worse now. With these massive companies inflating the market, we're setting ourselves up for a shock that could trigger an even bigger downfall than before. This next stage of the crash, the smart money exit, is perhaps the most telling. It's the stage that reveals how the system really works and shows who truly understands the game. Before every crash, the institutional investors, the ones with insider knowledge, begin quietly pulling their money out of the market. They sell off their stocks, increase their cash reserves, and prepare for the worst. In 1929, it was the biggest players like the Morgans and the Rockefellers who started liquidating their holdings months before the collapse. Bernard Baruch, a wealthy financier, was almost entirely in cash by September of that year. Joseph Kennedy, father of the future president, famously sold all his stocks after a conversation with his shoeshine boy. The boy had given him a tip on the stock market, which made Kennedy realize the market was overheated. He acted quickly and sold off his holdings, avoiding the crash that would wipe out the rest. Fast forward to 2007, and we saw the same pattern. Hedge funds, long before the collapse of Lehman Brothers, had already started shorting subprime mortgages. Goldman Sachs, for instance, was selling these risky mortgage-backed securities to clients while betting against them. As the market was rising, these firms were quietly retreating into cash, preparing for the inevitable. Today, we're seeing the same signs. Corporate insider selling is at levels we haven't seen in decades. CEOs, CFOs, and board members, those who know the true health of their companies, are dumping their stock at historic rates. The ratio of insider selling to insider buying is at an all-time high. Meanwhile, retail investors, like you and me, are continuing to pour money into the market, believing that the good times will continue. This is how it works. The smart money leaves first. The regular people, who are the last to know, become the exit liquidity. They are the ones left holding the bag when the market crashes. Stage 4 of this crash sequence is the liquidity illusion. This is the stage that sneaks up on everyone. From the outside, everything appears normal. Markets are stable, trading volumes look healthy, and prices continue to climb. Yet, beneath the surface, the liquidity, the lifeblood of the market, is drying up. Think about liquidity as the oxygen in the room. When it's abundant, markets function smoothly. You can buy or sell assets without significant price changes. But when liquidity starts to disappear, the whole system begins to wobble. It's not a gradual process, it's sudden. When liquidity drains, you'll see markets snap, prices gapping, and huge sell-offs that no one can predict. In the lead-up to the 1929 crash, this was a key problem. The Federal Reserve had raised interest rates in a bid to cool off speculation. But they didn't realize they were also draining the liquidity that kept the market stable. At first, it didn't seem like a big deal. The market kept rising. But when the sell-off started in October, there was no one left to buy. The bids just vanished, and stocks plummeted. In 2007, we saw the same thing. The Fed had raised interest rates, credit conditions were tightening, but the housing market remained high, and the stock market kept climbing. It wasn't until the collapse of Bear Stearns and Lehman Brothers that the truth became evident. The liquidity was gone. Suddenly, the market dropped 50% in just a few months, sending shockwaves through the global economy. Today, the situation is eerily similar. The Federal Reserve has raised interest rates at the fastest pace in decades, pushing the market to a breaking point. Yet, the stock market remains near all-time highs. But behind the scenes, liquidity is draining. We've already seen a few major banks collapse in 2023 due to liquidity crises. The cracks are beginning to show, and the stress is already there. Now let's talk about stage 3, the smart money exit. This is where the real game starts to show its ugly side. The smart money, the institutional investors, the hedge funds, the billionaires, and those in the know, start making moves long before the crash. They know what's coming, and they're already heading for the exits. You've probably noticed that these institutional investors never seem to panic. They don't rush to sell off their positions when the market starts to show signs of weakness. Instead, they quietly begin to pull back. They reduce their exposure, raise cash, and buy protective assets while telling the general public everything is fine. They keep the public calm, feeding them reassuring words, while they're already in the process of preparing for the worst. In 1929, this was exactly what happened. The likes of J.P. Morgan, Rockefeller, and others began liquidating their assets in the summer, months before the crash hit. They knew that the market was overheated, and they got out while they could. Meanwhile, average Americans were piling into stocks, convinced the market would keep going up forever. When the crash finally came, they were left holding the bag. In 2007, hedge funds were shorting the subprime mortgage market a full year before the housing crash. They saw what was coming, but they didn't tell the public. They made billions in profit while regular homeowners and retail investors were left to face the destruction. The very people who told you to stay invested were already selling and securing their wealth. It's a vicious cycle, but it's the way this game is played. Now, look at today. The insiders are once again unloading their shares at an astonishing rate. In 2023, corporate insider selling hit its highest levels in decades. The executives who know the most about their companies are selling off stocks, while the general public is buying. The smart money is already heading for the exits, and retail investors are once again providing the liquidity. This pattern has been followed every time in history, and it's happening again. Now let's move on to stage 4, the liquidity illusion. This is where things start to feel deceptively calm. On the surface, everything seems fine. The market is stable, trading volumes are healthy, and prices may even continue to rise. To the average investor, it feels like things are normal, almost like there's no storm brewing in the distance. But beneath the surface, the liquidity that keeps the market functioning is slowly draining away. Liquidity is the lifeblood of any financial system. It's what allows buyers and sellers to transact smoothly, to adjust prices gradually, and absorb any shocks that come their way. When liquidity dries up, everything changes. In 1928 and 1929, the Federal Reserve raised interest rates to try and cool off the rampant speculation in the market. They believed tightening monetary policy would prevent an overheating economy. But what they didn't realize was that this tightness was draining the liquidity out of the system. And even though the market seemed strong, when the crash came, there was no longer enough liquidity to support the selling. In 2008, we saw the same thing. The Fed had raised rates and was trying to slow down the housing boom, but the market remained inflated. When the crisis hit, the liquidity that had propped up the system evaporated almost instantly. Banks couldn't make loans, credit dried up, and panic set in. The collapse wasn't a slow decline. It was a sudden, violent crash, triggered by the complete lack of liquidity. Fast forward to today, and we're seeing the same signals. The Federal Reserve has raised interest rates faster than they ever have before. They've been draining liquidity through quantitative tightening, pulling hundreds of billions out of the system. Yet, the stock market remains near all-time highs. People believe this means we've reached a soft landing, but they're wrong. The reality is, the stress is already showing. We've seen major banks fail in 2023, not due to an isolated event, but because of the liquidity crisis caused by these rising rates. The Treasury market, which underpins the entire global financial system, has already shown signs of stress. Liquidity isn't just tightening in the bond market, it's everywhere, silently preparing the foundation for the next crash. This is the point where all the earlier stages converge into a catastrophic event. This is the match that lights the fuse. The trigger is what turns an already vulnerable market into a crashing market. But here's the twist. The trigger doesn't cause the crash, it only reveals it. In 1929, the trigger was an insignificant event in the grand scheme of things. A British financier named Clarence Hatch was arrested for fraud. It seemed like a small, isolated issue, but it set off a chain reaction. British banks, exposed to Hatch's fraud, had to sell off their investments in American stocks to raise cash. The selling created more selling, and within weeks the market was in free fall. In 2008, it was the collapse of Lehman Brothers that served as the trigger. But again, the problem wasn't Lehman itself. It was the fragility of the entire financial system. Lehman was just the spark. Once it fell, panic spread, and the financial system unraveled in front of everyone's eyes. It wasn't just one company failing. It was the culmination of all the preceding stages: excessive debt, market concentration, insider selling, and a liquidity crisis. Lehman was the tipping point, but the crash was already inevitable. So, what will the trigger be this time? We don't know. It could be geopolitical, something unexpected in Taiwan, the Middle East, or with Russia. It could be financial, a major hedge fund collapsing, a sovereign debt crisis, or a massive derivatives accident. Or it could be something nobody is talking about right now, just like the 1929 fraud case or the Lehman collapse. What we do know is that, as with every other crash, the trigger will happen within a short time frame. The 5 stages are already in play, and history shows that when they align, the crash follows closely behind. We might be looking at a tipping point in the next 12 to 24 months, somewhere between 2025 and 2026.
Now that you understand the sequence, the question is, what are you going to do with this information?
It's not just about knowing the pattern, it's about acting on it. We've seen the signs before: the credit explosion, the concentration trap, the smart money exit, and the liquidity illusion. They're all flashing red. Stage 5, the trigger, is the final piece. The crash isn't coming tomorrow, but the conditions for it are here today. So, the real question is, how are you preparing for it? We've been through crashes before, but this one will be different. This time, the stakes are higher. The debt is massive. The concentration of wealth and risk is greater than ever. The markets are more fragile, and the systems that once seemed solid are now teetering. And while most people ignore the warning signs, there's a group of people who have prepared. They've seen the pattern, and they're positioning themselves to survive, maybe even thrive. What will you do? Will you wait until it's too late, like most people did in 1929? Or will you take action now and protect what's yours before the trigger is pulled? Here's how you can start. Reassess your investments. Take a close look at your portfolio. How much is in high-risk assets? Are you heavily invested in tech stocks or in the S&P 500? These areas are particularly vulnerable right now. Consider diversifying into safer, hard assets like gold, silver, or real estate. Stay liquid. Having cash on hand could make all the difference when the market collapses. Liquidity is key, as it allows you to act quickly when opportunities arise. You don't want to be stuck in assets that you can't sell when the market turns. Consider hedging your risk. Invest in financial products that can protect you from a downturn. Hedge funds, options, or even shorting the market are ways some people are preparing for the inevitable crash. Pay down debt. The more debt you carry, the more vulnerable you are. Whether it's personal debt or business debt, reducing it now will protect you when the economy contracts. Prepare mentally. A financial collapse doesn't just affect your wealth, it can affect your peace of mind, your lifestyle, and your security. Mental preparation is just as important as financial preparation. In the coming weeks, I will be breaking down more details on how to safeguard yourself and your wealth as these 5 stages unfold. Don't wait for the trigger. Take action now and position yourself for what's ahead. Stay informed, stay prepared. The clock is ticking.